Futures turn higher after the jobs number beats. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the labor market bounces back from storms and strikes. The U.S. added 227,000 jobs in November, and that beat estimates.
And the view from the White House, BlackRock and Pimco. We'll get reaction from all of them on the jobs report, as well as acting labor secretary Julie Su, CIO Rick Rieder at Pimco is going to join us, and at BlackRock's going to join us, and Pimco economist Tiffany Wilding.
And Trump taps venture capitalist David Sachs as his AI and crypto czar. The pick underscoring, of course, the president-elect's intent to boost two rapidly developing industries. All of that and more coming up. But let's take a look at where markets are trading. As Matt said, 30 minutes until those bells ring. A little bit of green on the screen, a little bit of a lift after those numbers. It seems like the view prevailing right now is that we didn't get anything that is going to change the Fed's course this month when it comes to rate cuts. As such, a little bit of a muted but positive reaction. The S&P 500, the NASDAQ 100, higher a little bit to the tune of 0.1%. Then you take a look at the bond market, a little bit of a rally as it comes to the 10-year Treasury yield, down about 3 basis points. But watch these levels, Matt Miller. We are well below 420 right now, getting closer to 4%.
All right, interesting move in yields for sure. We're looking also at Tesla stocks within striking distance of a record high after losing, remember, 75% of its value in 2021, 2022. But Elon Musk, the world's richest man, has now given more than $270 million. It's won him great influence over the incoming White House. And now his buddy, part of the PayPal mafia, David Sachs, is going to be an advisor as well to Donald Trump.
That's a lot of money. David Sachs had given a lot of money as well. We'll talk about that a little bit more later in the show. Right now, we're going to talk about some stocks moving pre-market. Just Lululemon surging. More than 8%, almost 9% pre-market. There was strength in their international business. They lifted their guidance for the year. Ulta Beauty, another consumer stock, up more than 10% pre-market. Petco also rising higher after positive results. But higher, 23%. You know, I have a dog myself, so you gotta love to see it, Matt.
Yeah, I mean, you'd pay anything probably to keep that dog happy and healthy. The dog might have a job. We added 227,000, and that's better than the expectation. I thought it was interesting coming into this. You know, the whisper number was under the survey, so there was potential for a miss. But I guess after the 12,000 reading we got in the last month, this is welcome relief.
But what was interesting, and what I want to ask Julie Su as well as Mike McKee about, was the revision in October. It was pretty small, just 36,000. I think it was expected to be much higher than that when you think about how noisy the last reading was, but not a huge number there, Matt.
Yeah, I think it's interesting also the unemployment rate was higher, labor force participation lower. All in all, a muddy reading, even if they did beat expectations.
Let's get into this muddy reading here. Not as bad as the stormy one we got last month. Mike McKee joins us to give us the details. So we know the headline number's better. The unemployment rate's a little bit worse. How do you see through these numbers to what's really happening?
We're still looking at it through a foggy lens. I'm sure the Fed is trying to figure this out as well because there's some contradictory information in here. We did have 227,000 jobs, which was certainly lower than higher than anticipated. But payrolls for October we thought would make up a big portion of that, and they don't, with just 36,000 and a revision upward of 24,000. The unemployment rate comes in at 4.2%, but it's to 3 digits, 4.246. So it was basically just under 4.3%. The average hourly earnings, probably affected by the mix of jobs, doesn't change from last month. And we did see in the month that leisure and hospitality, healthcare, government, the things you would expect to see month after month, added jobs. But the surprise was in retail and trade and transportation. Both of them lost jobs in a month where they're usually hiring a lot. So there's very good possibility out there, I suppose, that we have a seasonal adjustment issue with those numbers. And then you also look at the number of people who joined the labor force. That was up, which would contribute to unemployment. But the number of jobs it created in the household survey was down by 351,000. That's all an explanation for the unemployment rate, but how do we compare the 227 to the 351,000? So some interesting divergences in the data that people are going to be looking at.
You know, this year has been a tough year to read the data. I think that's safe to say at this point. But also the surveys, the difference between the household and the establishment survey, they tell different stories, don't they, about how people are feeling about the job market and where participation is happening.
Well, they do, and they also include different criteria. If you're in the household survey, you don't have to have worked at all. If you're in the establishment survey, you get 1 hour in, and you're counted. But in the household survey, if you didn't work very much, you could say, I wasn't at work. So there may be a distortion there. The biggest issue for everybody, obviously, is what is the Fed going to think of this? And it's strong enough, but not too strong. We've got the weak parts in there that they can justify cutting in December if they want to. So now we move our focus to the jobs numbers. We saw the numbers for the Fed funds futures and for SOFR futures show more of a chance of a rate cut priced in both in December and January. So markets are taking this as a relative positive in the sense that bad news is good news, as it is often for the markets.
All right, Mike McKee, great breakdown. We'll see you in an hour's time. We have some sentiment data coming at the top of the 10, but let's keep the conversation going on what we learned at 8:30, because joining us now is Acting Labor Secretary Julie Su, live from Washington. Great to have you with us again. Let's start with, of course, the hurricanes and the strikes, because there was a beat when it comes to the headline number, but how much of that was simply a rebound from the jobs that we saw lost as a result of the hurricanes and those strikes?
Yeah, absolutely. That's right. You know, last month we said that the numbers that came out were largely affected by the tragic hurricanes, the fact that there were tens of thousands of workers on strike. Now that we are past that this month, we saw the numbers rebound again. And we often look at averages, so the 3-month average, even including that month of, of relatively low growth because of aberrational factors, is still 173,000. So the picture of this economy, as we've said over and over again, is one of a historic recovery of consistent job growth. And as you all remarked just before this, the unemployment rate remains really low. It not just as an absolute number, but in the face of really record high levels of labor force participation, and those are all signs of an economy that is, not just recovered, but has been consistently strong and stable and continuing to grow.
Yeah, good context there. Of course, we're talking about a slight rise in the unemployment rate, but historically still very low levels. But talk to us about the revisions. This is a puzzle that we were just trying to solve. You had a very small revision to last month's number, just 36,000 jobs revised there for October's number. That came in at just 12,000. The narrative there was, of course, that was going to be noisy when you think about all the different factors, weather, strikes, et cetera. But a small revision, how are you thinking about that?
I mean, I always say this, revisions are really part of the jobs numbers. We report new data when we get it because it's important to be accurate, and it's also important to be timely. So we put out numbers when we have them, we revise them each month. It's also notable that not only were the last 2 months small, they were also upward revisions. So as I always say, the revisions can go up or down. It depends on what data we get. And that's also why we look at averages. You look at the story of this economy from 2022, when it was hot and recovering and everyone said it was going to crash. It did not. It reached a more steady state in 2023, and we've definitely seen that continue in 2024. And I think the takeaway is, this has been an amazingly fast recovery. It's also been really broad-based because we've always said that when you prioritize workers, when you prioritize vulnerable populations, the economy is stronger. It's not just good for those individuals, but also we will be, handing off the strongest economy in history. And those were all not inevitable outcomes.
And while you could appreciate the historically low unemployment rate, the fact that it has been ticking higher, and if you round, you're getting closer and closer to 4.3%, how concerned are you about where the labor market is weakening and how fast it might weaken from there?
Yeah, I mean, it's still 4.1 to 4.3% since the summer. That is still, as we just said earlier, historically low. It was not anticipated to get that low as quickly as it did. I think, what this also tells you is that economic policies matter, leadership matters, and that is a big part of why we've seen the kind of recovery that we've had. And what comes next is going to depend also in large part on whether there is a continued focus on vulnerable populations, on working people. Again, this is the story of this economy with real wages up, and wages going up while inflation is falling is also not promised, but very much central to the Biden-Harris vision of what makes an economy good, what makes an economy strong. And so, I think hard to say what's to come, but those things, that vision is, I think, a really important part of how we make sure that the economy does well for everybody.
The other strength in the data was with the weekly earnings growth picture, where it registered at about 0.7% higher. And even though it's really the focus is on jobs here, the wage growth, wondering how much that signals to you that there's still persistent underlying inflation under the hood here.
Well, the average wage growth over the year is 4%, right? It translated into more concrete numbers. It's like $4,000 for an individual person working, even after taking into account inflation. So, more money in workers' pockets. I've said that a whole bunch of times because that's also really fundamental to how we think about, all of these things are numbers. But at the end of the day, for working families, for individuals, it's about how you feel when you get home at the end of the day. And that's why our commitment to creating not just a large number of jobs, over 16 million since this administration came into office, but also good quality jobs with workers have a real voice, have a real ability to make a good living, to be able to retire at the end of the career with security, have all been really fundamental too. And so I think when you put up wages against inflation, it's a consistent story too, that we shouldn't have to choose, workers shouldn't have to choose, right, between having a good job where they can afford things and our ability to tackle inflationary pressures. The trend in this economy has also been up on wages and down on inflation.
All right, Secretary, we really appreciate you braving the cold for us. Stay warm out there. That is Acting Labor Secretary Julie Su. Meanwhile, let's take a check on futures right now. Less than 20 minutes until the bells ring. You can see a little bit of a lift in the pre-market. The S&P 500 up about 0.2% if you round up. The NASDAQ 100, a similar story. Where you're seeing real outperformance is the small caps. The Russell 2000 up about 0.8%. Of course, the narrative here is that the Fed is going to proceed with that rate cut in a couple weeks' time. That would absolutely be good news for the little stocks out there. We'll keep an eye on that. And coming up, a great conversation. Rick Rieder, he is BlackRock Chief Investment Officer of Global Fixed Income. We'll get his thoughts on the latest jobs report and what it means for the Fed and for the bond market. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. You take a look at this lift in futures right now. A lift in the bond market, of course. Yields down, price higher. 10-year yields down about 4 basis points. Now, Matt Miller, I know you have a lot to say.
Well, I just, see the 10-year at 4.13, and I note that that's the lowest we've seen in a couple months now. And also the mechanics of it are interesting because we can look at WIRP to justify or to, I guess, evidence the fact that markets expect a cut. But you can look at the bond market pretty easily. So if you think there's going to be a cut, you want to buy the bonds today to get that coupon before it gets lower. And that's exactly what we're seeing, right? Buying those bonds, pushing the yields lower.
Well, anyways, we have the perfect person to talk about that, don't we, Matt?
Yeah, we do. Rick Rieder is here. He works at BlackRock. You may know him as the Chief Investment Officer of Global Fixed Income. He also runs the BINC ETF, BINC, handily beating the benchmark and returning, I think, 5.9%, which is better than a stick in the eye, Rick. Tell me what your response is to the jobs number beating and, the smaller revisions than we expected, the unemployment number. What do you see there?
So I'd say one thing. First of all, I think the market had set up for a pretty strong number after the hurricane-related number before that. So I think there was a little bit of relief from that. I also, when you dig into this number, the unemployment rate, and Mike McKee talked about this, the unemployment rate ticking up, representative of the fact that, gosh, you're seeing some moderate softening in what is a pretty solid labor report, labor market. So a little bit softer when you cut through everything and, expectations that were high. Listen, I think there's some things when you go through it, you look at this leisure and hospitality, it was a pretty good number, so that was solid. But then you go underneath and say, where else? So temporary hiring I thought could bounce back a little bit more after a pretty significant negative the month before. So on balance, with the unemployment rate ticking up a little bit, the Fed can go in December, and then we got a CPI report that's important, so we got to see that next week. But probably the Fed can go in December, and then still uncertain how much more they have to go after that.
Rick, you've talked a lot on this program about how you've liked to invest in the belly of the curve, and we get really jazzed here on this program talking about the moves we've seen at the longer end. Are you excited about the longer end? Do you think that there's a possibility or still too much risk there to extend out on duration?
So if you take the grand suite of investments in the world today, so I'm thrilled that you get excited. I get excited about the fixed income markets, but it's also equities are going up over 20%. Like, that's more exciting. So if you said, I could take risk in my portfolio, do I need long end interest rates, which is obviously a long durated asset, or would I buy equities for my long duration risk? Like, I'll take equities all day with an economy that's growing, an operating leverage machine called the S&P 500. I would take that, and then I just clip loads of yield in the front of the belly of the yield curve. If we can create income, and Matt was kind enough to describe it in our ETF, if you can create income and build 6.5% yield, just buy income. I don't think rates are going very far. Certainly in the front end, we'll see how much the Fed can go, and then I just take my risk in the equity market, particularly when equity volatility is so darn low. You can protect your downside that way.
That's a really interesting.
You don't need rates to protect your equity.
Yeah.
Sorry, go ahead.
No, I was just going to say that's an interesting way to look at it from a portfolio construction point of view, that you take your duration risk in the equity market. And it's been a while that you've been preaching, T-bill and chill, just clip your coupons, be happy, don't overthink it. When does that change? What are the ingredients that need to come to fruition for that mindset to shift a little bit?
Yeah, it's a great question. So it's not today, and it's not going to be January. So, we've got to resolve the dynamic of, we got tariffs, maybe a systemic strategic decoupling in the world, and you think about U.S., China, and how do you think through that? Tends to be an inflationary dynamic. You also have the dynamic at play today. We've seen a lot of improvement in inflation. My guess is next year you won't see any more significant improvement, and it probably trends up a little bit more. So I don't think it changes that paradigm unless you believe the economy softens considerably, which I don't think is going to happen. So I think you got a little bit of time. And, I still believe, like you were describing, this idea, stay in the front of belly, clip a lot of yield, use some of the credit markets, securitized markets, clip. By the way, Europe is going to slow. It is slowing faster. Get some European fixed income while you're buying U.S. equities. That, to me, is a better expression.
Rick, I guess the Fed in Washington matters less than what's going on at the Winter White House at Mar-a-Lago. What do you expect from Trump land? What do you expect from the incoming administration especially in terms of tariffs and deportations? Because that's going to have an effect on inflation, and frankly, it's going to have an effect on what we see in terms of deficits as well.
So it's a hard question. My sense is you have to interpret today that tariffs are going to be the tool of negotiation for this administration, which, as you said, creates some near-term inflationary dynamic. By the way, it also dulls growth. So there's going to be a transmission that we've got to watch pretty carefully. A bit higher inflation, maybe growth trends down alongside that, but then, ironic, and by the way, some cutting of spending, which does dull some of the growth. And then, so we got to keep an eye on that and see how much that takes place. My sense is growth, you look at the U.S. consumer, including the data that we got today, U.S. consumer, when you actually take the income data that comes off of today's data, it's actually pretty good. U.S. consumers in good shape. CapEx in the country is still in pretty good shape. You got an economy that's moving along pretty well. And my sense is the administration will want to propel that forward while trying to bring the deficits down, cut some spending, keep inflation down, or try to keep it down through things like deregulation, energy dynamics. But, we're going to learn a lot alongside of that. But listen, I think you can invest in that environment.
You're not the only one who thinks that. We can see from the market that a lot of people agree with you. What about the tariff seems to be our focus, although the mass deportations, and remember the signs at the Republican National Convention, they're serious about deporting millions of workers from this economy on a day when we're focused on the labor market. What does that mean?
So it's a question of how much is going to happen. And so, by the way, if you look at today's job report, and if you look at the jobs report for the last 2 years, 3 years, huge amount of how we filled the labor roles, leisure, hospitality, restaurants, hotels, airlines, was actually through immigration. The transmission, and I'm sure the president and the administration doesn't want to reverse that trend of any significant magnitude while dealing with the illegal immigration. My sense is it's somewhere in the middle, in that you deal with the illegal immigration, but try not to cut off good immigration that flows into things. By the way, also the technology sector, don't cut that off, and make sure the economy's still moving along with, and what grows the economy is if you can grow the labor force, you can grow the amount of wage, aggregate wage, and immigration does that. So my sense is they're going to try and complete a very fine line of trying to complete that effectively with not slowing the economy down.
I almost want to pinch myself for asking this question, but I am surprised at how much it comes up on this program. This whole idea of government efficiency, Doge. A guest earlier this week pointed out that Dogecoin's market cap was $64 billion nearly. That is more than 3 times the size of the Carlyle Group. And so if you think about the efficiency measures that could be put into place, Rick, are you really convinced that it could make a dent in what we're seeing for the U.S.'s fiscal situation?
So I think making a dent is probably the right dynamic. Are there things that you've got some pretty smart people are going to try and cut spending out? It's not that easy because there are so many entrenched programs that are, quite frankly, politically favorable, and I'm not sure Congress is going to allow for significant slashing there. The only answer to make a big difference in the debt is you got to outgrow it. And so the idea is, like, you want to keep the economy moving. If you can grow nominal GDP at 4.5 to 5 and the cost of the debt stays at 3.5-ish, then you can outrun the debt over time. And to your point, I don't think you can elegantly cut spending enough and without slowing the economy down that you're really going to create that much of an improvement. You got to outgrow it. And by the way, U.S. economy, the amount that's being spent on AI and clean energy and other forms that impact infrastructure, like, that's the only way to do it. That's where you make a big dent.
All right, it's a great point. You can't cut your way to growth. I do want to talk about Bing before we let you go. Of course, it's your fixed income ETF, up about 6.5% on a total return basis year to date. If I take a magnifying glass to your holdings, I see a slight rise in securitized products, a slight rise in your high yield holdings. I also see agency MBS coming down. Is that the market moving things around, or were those conscious decisions? You're pretty accurate. So those were conscious decisions, and some of that is with the rate volatility. Do we need to own as much in the mortgage sector? By the way, I still like agency mortgage, still high quality, super liquid. But gosh, I mean, getting yield, I really, kind enough to mention, I just think it's income. It particularly in the front to the belly, and where if we can still get 6.5% yield, and you look at like European high yield. As a dollar investor, you can get 8-ish. Like, getting that income is still pretty attractive. And credit's in great shape. The economy, it's operating well. They paid down their debt. They termed their maturity walls out. So that was a largely conscious decision, which you were kind to point out.
Rick, great to have you on the program. Thanks so much for joining us. Rick Rieder there of BlackRock. And, it's so interesting. We have to fight to get Rick on this show.
I know.
Because obviously Surveillance wants him on their show. The ETF wants him.
Yeah, that's true.
Do we still do that interest rate show in the afternoon on Friday?
Yes. 12 o'clock today. Everybody watch. It's a great show. But, the point he's making about junk bonds, he's not alone. You have junk bonds really headed for its third set of weekly gains. The market piling in right after him.
Well, it certainly helped him beat the ag. Some handy outperformance there. Coming up, it's the opening bell. Don't go anywhere. We'll walk through all the big market moves. This is Bloomberg.
Futures moving slightly higher on this jobs day. We're moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. You can see it's very slight. So S&P futures up only 0.1%. NASDAQ futures as well. Wow, Russell 2000 futures powering higher on hopes that the Fed will cut rates December 18th is when we get that decision, and of course it would be more beneficial to those smaller cap stocks than the big boys. Albany International ringing the bell at the New York Stock Exchange. Down at the NASDAQ, you've got MMMC. Not really important. What really matters is what's the Fed going to do in the shorter term, and then longer term we have other worries. But in terms of the cash trade, Katie, are we going to see another record today?
Well, we'll see, because yesterday ended up being a little bit ugly for the major averages, at least for right now. You take a look at what's transpiring behind me. The S&P 500 building on that early momentum, up about 0.2%. Similar story if you take a look at big tech, the NASDAQ 100. I'm flying through this, though, to get to the Russell 2000, because that is the outperformer today. And Matt, you said it well, that when rates go down, the small caps are supposed to go higher. That is the logic working its way through the market. The Russell 2000 up about 0.7%, just 53 seconds into the trade. Meanwhile, we take a look under the hood, because earnings season, it's still here. And Lululemon is surging after the activewear brand lifted its full-year net revenue guidance. Analysts also highlighting strength in their international business, and this stock needed it, because through yesterday's close, it was down 32%, Sonali, currently up about 12%.
I'm watching another retailer here, because if jobs are generally strong, so are retailers. Wages strong too. Ulta now up almost 10%. Good day for retail, kind of across the board, isn't it? Shares are jumping of Ulta after the beauty retailer reported better than expected results. It also raised its full year outlook. Matt, people are buying makeup.
Yeah, not me, but I'm glad, I guess. I don't know if I'm glad.
Are you wearing makeup, though?
I don't wear makeup typically.
You're supposed to.
I know. Let's not tell anybody, otherwise the boss is going to be like, you have to. It's HD, right? So you can see every pore. Petco also positive after results beat analyst estimates. Morgan Stanley said there are signs of stabilization in that business, and it's mostly because of Loki. Let's get a closer look at the broader market right now as stocks rise following the jobs report. For that, we go over to Abigail Doolittle.
Well,
Abby?
stocks not just rising after the jobs report, Matt, but we also have a weekly gain. In fact, over the last few weeks, we've mainly had gains for stocks. Let's take a look at the NASDAQ 100 over this time period, up a very healthy almost 8% since the presidential election. In fact, today, B of A's Michael Hartnett saying that stocks and Bitcoin, well, they might get a little frothy in 2025, that stocks could go higher from here, but there's reason to think that there could be some kind of a pullback in the new year. If we take a look at valuation for the S&P 500, we will see Michael Hartnett's point. This is price to book, and you can see right now well above 5, the peak a little bit higher back during the tech bubble, a healthy price to book where you would really want to buy a stock less than 1. So you can see, again, very overvalued. In addition, you can see this massive rally higher. 2 legs of it, pretty parabolic. Parabolic uptrends do tend to consolidate in some way or form, and you can see that happened out of the pandemic rally into 2022. So perhaps Michael Hartnett will prove correct about some sort of cooling off in 2025 for a period of time. As for Bitcoin, well, of course, over the last 2 days, it's been a wild ride. More than $10,000 worth of intraday volatility on Bitcoin as it went back above 100. You can see, though, over the last month, out of the election, the Trump trade, the idea of pro-America, up more than 31%. And, of course, his administration expected to be friendly to Bitcoin, and the related ETFs and stocks, well, they are really on a tear.
Really on a tear. You just can't escape crypto. Abigail Doolittle, thank you so much. Let's keep the conversation going now with Gabriela Santos. She is JPMorgan Asset Management Chief Market Strategist for the Americas. Great to see you in person.
Great to see you. Thanks for having me again.
So we get these economic data releases, the jobs report at 8:30, then we contort ourselves to figure out what the Fed is going to do. And with that in mind, I love this first line in your notes. Don't miss the forest for the trees. It's all about fiscal policy, not now monetary policy. Tell me about that.
That's right. I think we've been used to, over the last 15 years, really, to focus a lot on what's going on with the Fed, what's going on with monetary policy globally. I think what the Fed is telling us is we're pretty close to the end of this adjustment period lower with rates. And now it's really about fiscal policy and governments really telling us that they're going to keep these very elevated deficits, very high debt issuance. And so the attention for us next year is really what's going to happen with the 10-year. You could make arguments for it to stay in a pretty wide range between 4-5%, maybe testing that 5% ceiling from last year. And really, a lot of attention is going to be paid on the evolution of the tax bill next year. Baked in that the $4 trillion in expiring tax provisions will be extended. The conversation really is additional tax cuts, where there's the potential for $3.5 trillion more.
I feel very vindicated because I wake up in the morning and I make Matt look at the 10-year. And for a while there, he's like, yeah. But you look at it now and you have people thinking it could get as low as 3.5%. I didn't hear that in your calculation here. Do people have it wrong?
They're a little hopeful, right?
Super hopeful.
I have a hard time seeing it get to 3.5%, honestly below 4% on a sustainable basis until we get the eventual next recession. Part of it is for good reason, higher nominal growth. We've seen an improvement in productivity. There is a certain amount of inflation back. But part of it is related to this persistent elevated deficit as far as the eye can see, actually potentially above 7% if all the expiring provisions are extended. And additionally, if we get those additional tax cuts, and I think this is true globally. We're seeing what happens in France. We're seeing what happens in the UK. So the US is not immune to there being a certain premium that investors demand for lending for such a long time to the government.
Even without COVID spending, Donald Trump added far more to the deficit in his first term than even, big spending Biden did. Can we expect the same, you think, in the next Trump administration? And do the bond vigilantes ever come back in force?
This is truly a bipartisan issue, right? And I think part of it is because of how hard it really is to cut government spending. About 80% is just entitlements, defense spending, interest spending, and that's only going to go up from here.
Well, do you have any faith that Elon Musk and Vivek Ramaswamy are going to be able to reduce the budget by $2 trillion?
I think it's a worthwhile effort. We just have to moderate expectations about how difficult that is. Non-defense discretionary spending is only 13%. It's hard to squeeze some juice there without making tough decisions around entitlements. And then in terms of revenue raising, there's the discussion about tariffs. Tariffs represent only 1% of government revenue. So we really have to 1,000x the tariff revenue here for it to make a dent, really. And we're talking about additional tax cuts. That was going to be true regardless of the outcome of the election. That's why bond yields have stayed persistently above 4%. Now the discussion is additional tax cuts. For example, exempting tips or overtime income or cutting corporate taxes additionally.
Well, let's bring this conversation to the stock market because we talk about all these different cross currents, what it could mean for the long end of the Treasury curve. You write that for asset classes across the board, it's the long end that you need to pay attention to. So how does this filter through to the equity market?
I think for equities, it's all about, as it has been this year, why the 10-year is moving higher. So especially over the month of October, it really was moving higher for good reason. Resilient data, the job scare from the summer had passed. Things are looking all right. It's just a normalizing, pretty good labor market and economy. I think what we have to watch next year to see if this starts becoming a hurdle or potentially a catalyst for a correction in equities is if the 10-year starts moving higher, much more about this fiscal concern, or if it starts moving higher because of inflationary concerns again. So unfortunately, I thought we were done with inflation. I think next year we have to watch that again, and specifically inflation expectations, which have moved higher by 60 basis points since mid-September.
Looking at fiscal policy, looking at the long end, is it fair to say that Gabby's research is driving our conversations with every guest today?
Yeah, it really is. And the other part of this too, we were speaking to Rick Rieder at BlackRock just a little bit ago, and he mentioned growth concerns. And if you're concerned about growth, then what does that spillover look like into the equity market, particularly if you're one of the investors that believes that a lot of the growth this year was really kind of at least backstopped, if not propelled by government spending?
So I think in terms of growth, there's a nuance. What we've been seeing in the economy, in consumer spending, in the job market, in cyclical sectors like manufacturing and housing, is normalization. By normalization, though, we do imply a certain downshift in the pace of growth from the 3% we've been seeing this year towards a 2 handle, a 2% next year. And then there is some optimism about certain elements of economic policy, lifting of animal spirits we started to see, but there are also countervailing aspects of economic policy, like an increase in trade policy uncertainty. So for next year, we're penciling in about 2% growth. As you get that deceleration, you might have moments of correction in the market. But overall, I don't want to leave the bearish impression here. We still think there's opportunity in risk and equities and corporate credit. It's just that I think you have to work harder to really get that access to that pretty decent growth story, especially with valuations, as you were mentioning, where they are now.
Well, that's a great note to leave it on. It's great to see you again. Come back soon. That is Gabriela Santos of JPMorgan Asset Management. Now, coming up, the retail roundup. We'll take a deep dive into results from Lululemon, Ulta, and Petco. This is Bloomberg. Welcome back to Bloomberg Open Interest. A quick check on stocks. Green across the board right now. The S&P 500 up about 0.3%. Big tech making a run for it, gaining some momentum here, up 0.4%. But your leader so far in the U.S. trading day is your small caps. The Russell 2000 up about 0.7%. The expectation is that the Fed is going to cut rates this month. It's helping the little guys. We'll continue to keep an eye on that. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Bank of America is upgrading Molson Coors to a buy. The firm says that 2025 will be more normal now that the company and the wider beer industry has moved past the Bud Light controversy. Next up, Peloton gaining some traction. UBS quadrupling its price target on the fitness company, also raising its recommendation on the stock, saying that it's no longer a sell. The analyst highlights additional cost cuts that will help boost its outlook, and Peloton now only has one sell rating on the street. And finally, Jefferies is downgrading Deere, saying it's no longer a buy. The firm cites valuation concerns for the company and says that the ag sector may be at risk from possible China tariffs. Matt?
All right, interesting rundown. Let's take a look at some more individual stock stories. There were earnings out last night in the retail sector that I think many people here on set found fascinating. Lululemon is boosting its outlook on strong sales overseas. It's a sign the upscale activewear brand is successfully navigating slower growth in consumer spending. Joining us for more is Bloomberg's Bailey Lipschultz. Not a customer.
Not a customer.
Come on. They have a men's section.
I'm cheap, though. So I'm like a discount. I've worn the same pair of soccer sweats since high school.
Well, as we learned yesterday, you're flying back and forth between the coasts.
I'm spending all my money on United flights, so I'm keeping them in business. And
we know what we're going to buy for Christmas presents for you, too.
Wait, you guys are getting Bailey Lululemon pants for Christmas?
I was going to buy it for you, but I can't keep it secret.
Anyway, Lululemon, some international strength.
International strength. Stock up at 1.18%. That was the biggest intraday jump since 2016. We were talking about it yesterday, Scarlett and I. U.S. sales ended up being flat on the third quarter, but the big growth, 39% jump in China. So when you're trying to tease out what companies are going to be better positioned for the move forward, clearly seems like Lululemon is tapping Asia, which I don't think many analysts really had on their bingo card.
It's amazing they're still doing so badly over the last year, right? And year to date. So down.
It kind of reminds me of Peloton. Like, you have such a brand name in Peloton and Lululemon, and then you take a look at the stock price and you say, uh-oh. So
you've got to wonder if there's a correlation also. Well, the other thing, too, is Ulta. You know, you wonder after this earnings season what you can draw in terms of conclusions on how the customer is behaving. People are buying makeup, but Ulta's still down on the year.
Yeah, the big thing with Ulta is competition. So you have the partnership between Sephora and Kohl's. You have people who are shopping online, buying goods from Amazon. In the report, they did increase their annual projections for comp sales and earnings better than Wall Street was looking for. But to your point, still down almost 10% in the last 12 months. Biggest jump right now, 14% since 2020. When you look at how consumers are spending money, especially here in the U.S., and how they're trying to either cut costs or kind of like the K-shaped recovery where people who can't afford to spend are spending, Ulta kind of falls in that interesting spot to keep an eye on.
Yeah, absolutely. Real bellwether it's turned into for the beauty names. Billy, we're going to ask you about Petco, and then we're going to talk to Sonali about it. But Petco soaring as much as 28%. It reported earnings. That's a big jump. But then you take a look over the past year to date, it's up like 83%. So
you got to keep in mind, about 30% of the shares are sold short. When you look at the past earnings reports going back,
30% of the shares are sold short?
Okay, see, I didn't want to yell about it, but yeah. So this is a short squeeze. When you look at past quarter movement, last time jumped 22%. Quarter before, 33% gain. Quarter before that, 18% gain. You go back a year, 29% drop, 21% drop, 18% drop. It's a meme stock. Like, it's a name that people know. It's heavily shorted. You're trying to tease out whether consumers are going to go to stores and be able to afford it. But, Sonali, not everyone shops at Petco. Like, you're not a Petco user.
But you don't even, what's the Lululemon of Petco?
The foggy dog.
Okay.
I've never even heard of that.
Oh, it's so good. But you know what? My dream would be like pet brand consolidation, right? Like the discounts on Petco, a foggy dog. Oh, like, you know, now you have me. But, you know, that's a long time out. Bailey, thank you so much for joining us here on set. That is Bloomberg's Bailey Lipschultz. A lot going on in the retail world, but we're going to move to politicals. We are going to talk about President-elect Trump next, adding venture capitalist David Sachs to his cabinet. We're going to take a look at the impact of that in today's Wall Street Beat. This is Bloomberg. It's time now for the Wall Street Beat. Today we are looking at San Francisco and Donald Trump's decision to go all in with David Sachs. He selected the venture capitalist to serve as his artificial intelligence and crypto czar. I correct, it is not a cabinet position here, but it is a spot that will put him very close to a lot of decision making. Here with more is Bloomberg Technology co-host Caroline Hyde. And this post itself had a lot of eyes on it because of the crypto role, because of the importance and rulemaking around the future of AI, particularly Gen AI. But even before all of that, how did David Sachs get here? I mean, he donated a lot to the Trump campaign, but he has to both political parties. How did he get here?
Yeah, he's an issue-based voter, ultimately, is what he'd say. But he has recently very much aligned and come out saying and he's in support of Trump, largely because of the economy. In fact, go on to his X page. He's an investor in X. He's a big investor in Elon Musk more broadly. And, of course, he was part of the PayPal mafia. But he's written his whole thesis on why he was backing Trump, whether it be about the economy, the border, about foreign relations, in particular Ukraine and Russia. But he is someone who's on the all-in pod, become closer and closer to many people who ran for office, whether it be Ron DeSantis, whether it be Vivek Ramaswamy, and then eventually going all in on Trump. But this is the role that everyone was looking at in terms of AI and crypto. And this man, no matter what your political beliefs, you've got to hand it to the guy. He makes incredibly sound venture backs. He backed Meta at an angel round. You're looking at Palantir, he backed at an angel round. He's been in some of the most successful exits that you have ever seen come out of Silicon Valley. He's built a $1.2 billion exit company himself, Yammer. And when you just look at the who's who of Craft VC, which he currently has, this man knows his understanding of crypto. They're in Lightning networks, they're in Bitwise, BitGo, and in an awful lot of AI companies. In fact, he joined the show 6 months ago to talk about Glue AI, which is an AI backing of his. And I think we can just bring you some sound of what his view is on artificial intelligence.
There's innovation happening at every level of the stack. I mean, you're seeing tremendous innovation at the foundation model layer. You've got OpenAI, you've got Anthropic, like you've mentioned, you've got AI now launching that we just invested in. Then you've got innovation happening at the application layer of the stack, where applications are able to take advantage of all the new capabilities created by these LLMs. And if you're positioned correctly in the application layer, you don't want to compete against the models. You want to harness them so that as the models get better and better, your application gets better and better.
He's going to have less time to build Glue AI, obviously, because he's going to be spending up to 130 days advising the government.
Yeah, interesting to hear him talk about XAI. And for those who haven't listened to All in Pod, I just want to say it's fascinating to see how they've gone from the world of technology. They've really broadened out to your point, the nation's affairs in a massive way.
To the nation.
The nation's affairs.
Healthy obsession with poker, too.
Yes.
Poker. I thought you said hoka for a second. I looked at Katie.
Running shoes?
So you said 130 days. That's the most that he can work, I think, officially for the government without having to divest his interests. He's going to stay on at Kraft, right?
Yeah.
He is allowed to continue his investments in crypto as he advises the White House on crypto, right? So are there any conflicts of interest here?
I mean, there might well be, and he's going to have to recuse himself if they do come about. Look,
he's supposed to, right?
He's supposed
when you
to.
say he's going to
And
who gets to judge that?
Well, we will, hopefully, and we'll understand. They're going to bring an air of transparency. That's what everyone has been focusing in on. And look, we'll have to question the same for Vivek Ramaswamy, who himself is also an investor. And when you have to look at Elon Musk himself, many are going to have to recuse themselves, but many would argue that those that are close to the frontier of business building, that understand how difficult regulatory situations are, and indeed how many layers of regulatory tick boxes you have to go through in construction, for example. That's some of the companies that David Sachs backs. Maybe they are the ones to ask. But yeah, it's going to be a very difficult tightrope to walk to ensure that people don't think that they're basically backing themselves, backing their own investments.
No one would think that, right?
Who would be that cynical?
You don't think that Elon Musk spent $274 million to buy influence in order to boost his business interest, do you?
Are you a professional Elon hater? Because that is what David Sachs is calling a lot of mainstream media. It must be said that if you listen to All Empowered, you do know some of the reticence and issues that David Sachs and a lot of those on All Empowered have with mainstream media and indeed what they say about Elon Musk in particular.
All right, Caroline, great roundup, of course. A really interesting appointment here. That is Bloomberg Technologies' Caroline Hyde. She's on right after this show at 11 a.m. But don't go anywhere, because coming up in the next hour, we'll speak to the CEO of Janus Henderson on 3 macro drivers investors must navigate in the year ahead. Plus, an exclusive interview with the CEO of Ducati. Matt Miller, I know you're excited for that.
I'm very pumped. Claudio Domenicali is going to come on after Ducati has won its 3rd world championship in a row in MotoGP. And we'll find out if win on Sunday, sell on Monday actually is true in the luxury motorcycle business. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. You take a look at markets right now. There is green on the screen, hot off that 8:30 jobs print. Of course, we do have consumer data coming in a few seconds as well. And you can see the setup pretty bullish right now when it comes to the broader equity market and the bond market as well. And here we have at the University of Michigan, preliminary December figures coming in at 74. The survey had been for 73.2, and the prior month was 71.8. So a lift there, as you can see. Current conditions also coming in hotter than expected. And then you take a look at inflation expectations, pretty much bang in line. Let's break it all down.
No. 1 year inflation expectations, 2.9%. We were looking at 2.7.
That's true. That's true. And that is a rise from the previous month. But then you take a look at 5 to 10 year inflation.
That's way out there.
3.1%. Yeah.
5 to 10 years.
Let's talk about it.
You need to buy a mortgage with that kind of timeline. Come on.
Mike McKee joins us here on set. So that's a notable increase in inflation expectations. Last month was 2.6%. What do you think?
Well, we're going to have to check into this further, but it looks like people are absorbing the idea that tariffs will increase inflation. That's what the University of Michigan is saying in its preliminary note here. And we're also seeing people, the buying intentions get pulled forward because people think that prices will go up and, because of tariffs, and they should buy things now, which is a very interesting result. Obviously, we see Republicans feel a lot better about the economy going forward, and Democrats feel a lot worse, but both parties seem to think that tariffs will add to inflation. The overall sentiment numbers, 74, that is an increase expected after the election because it's over and the drama is over. But historically, Republicans have contributed more to that number in terms of when they're happy, it goes up more than for Democrats. So that's one reason we see a big move. Current conditions, it's hard to argue that things aren't pretty good right now, so maybe people are buying a little too late, the Biden-Harris argument, and then expectations fall, and that, again, could be because people are worried about tariffs and what else might happen.
Yeah, reiterating here, a quarter of respondents said that they would buy big-ticket merchandise now to avoid higher prices in the future. How problematic is that? I mean, at the end of the day, does this mean the consumer is strong or not?
Well, I have to go back to what Alan Greenspan said many years ago. The Fed watches what people do, not what they say. This data here kind of gives you an idea of where people are, but it doesn't correlate well with actual trends in spending going forward. So we'll have to see what people do, and I'm sure that the American consumer is in kind of the same situation as the Fed. They don't know the details of what's going to happen, and if the president puts tariffs on imported widgets that go into some sort of machinery, then that's not going to affect people's buying plans. If he puts tariffs on refrigerators, then they're not going to buy refrigerators. So it all depends on what ends up happening.
All right, Mike, thanks very much. Bloomberg's Mike McKee. They're breaking down the numbers for us from University of Michigan. Mike is going to have a Q&A with Joanne Shu of the University of Michigan Survey Research Center, so we'll get more on that. You could follow on LiveGo if you have a Bloomberg terminal in front of you. It doesn't look like it's moved the markets much at all. I look at the 2-year, and it's just the same as it was at 408. Let's talk about fixed income right now with Tiffany Wilding. She is a Pimco economist. And Tiffany, we've had a decent jobs number today, and we've had a good consumer confidence number today. How does the U.S. economy look to you?
Yeah, I mean, I think overall, when you look around a range of data, it looks pretty good, I guess, to state the obvious. I think we have had growth that's been that continues to surprise on the upside. It looks like the momentum in the back half of this year, setting us up for next year, has been quite strong. I think, the most important, thing that we would really point to is just that productivity growth in the United States has just outpaced everywhere else in the world. And it also looks like it's been strong. So I think the big question here is, are we kind of on the precipice, or are we seeing just a trend higher in productivity growth, as U.S. investment, really stays strong here?
Well, I also want to talk about what we just got at 10 a.m., those numbers that we were talking about with Mike McKee. Of course, you have sentiment coming in higher than expected. That makes sense when you think about the fact that we are past the election here. But let's talk a little bit more about that 1-year inflation expectation. 2.9%. We had been looking for 2.7%. Mike McKee's explanation was that, of course, people are anticipating the effects of tariffs. Do you see that sort of behavior when you take a look at other data sets as well?
Yeah, I mean, I think it's actually quite interesting. It's certainly possible that some of the strength in consumption that we're seeing is people pulling forward their purchases ahead of potential tariffs. We're also seeing it in the trade and inventories data potentially. So, you've seen more imports trying to import ahead of tariffs. That's also accelerated some inventory accumulation. But of course, consumers are buying some of that. So overall, I think it's possible that we could be getting that, and I think that's why. It's a little bit tricky. I mean, the U.S. economy looks strong. It's been strong, but certainly if we're getting some of this pull forward, then what that just means is that next year or at some point that that really decelerates as once tariffs are in place, as consumers have pulled forward all of that activity.
Speaking of pull forward, if you look at the market pricing right now, you have, for that December rate cut, you have a 90% chance baked into the market. If you look at January, it looks like now a 30% chance. So over the last week, you've seen those chances really rise. And clearly the data is weak enough to justify to investors that they would see such a thing. But do you think January is baked in? I mean, is it in the bag with the data that we're seeing now? Do you think that investors might be getting a little ahead of themselves?
Well, I mean, so obviously markets can move around, and they have been. But I guess the way that we would describe in our expectations for the December FOMC meeting is that you will get we think you likely will get another 25 basis point rate cut. But at the same time, when the Federal Reserve releases its new summary of economic forecast projections, you'll see just a expectation for, a stronger, more resilient economy, maybe a slight uptick in their inflation forecasts. And they pair that with an upward revision in their rate path. And we think what that does is it results in basically a sequence of rate cuts that happened in 2024 that was more quick and more aggressive, but then they're a very strong signal that 2025 is going to be a much slower pace, so they can see how the economy evolves. Obviously, there's a lot of policy uncertainty now as the Trump administration is readying to go into office. The details around those policies will matter. How much tariffs will will actually increase and how much you could see government spending try to be reduced, all of those things. And so the Fed will kind of want to wait and to see how all of that plays out.
Tiffany, how much will we see government spending actually reduced? I mean, how likely is it that we get $1 trillion or maybe even, let's say, $500 billion cut off the budget?
Yeah, I mean, so I think that the 3% budget deficit number, like kind of goal or target number that's been discussed by the Trump administration is very, very aggressive. And I think that would, the growth implications for the economy, if that was done in a year or two, I think would be quite dramatic. It's very inconsistent with the 3% growth target goals that they also have. But I do think there is some, under all of that rhetoric, there is some legitimate potential ways that you could try to reduce government spending. There are a myriad GAO reports, Government Accountability Office reports about how there is government waste, fraud. There's always discussion around auditing the Defense Department and things like that. So I think there are certainly things, incremental things that they could do that would be good. And by the way, there was a bipartisan commission during the Obama administration, the Simpson-Bowles Commission, that came with a wide range of recommendations, including eliminating waste and fraud, kind of very similar to some of the things that currently the Doge is talking about. Many of those things never got implemented. The funny thing about that is you probably have to actually hire more staff for the government, not get rid of staff, in order to get some of those policy efficiencies. But you know what? We'll see how it shakes out. I mean, I think it's certainly good that they're looking at these things.
Yeah, and like the sentence that we'll see how the Doge operates, you think about hearing that 6 months ago, I would have had no idea what we're talking about. But we'll see. And you take a look into 2025, some of these goals that should increase growth theoretically. And then you think about the risk of tariffs as well, potentially pressuring inflation maybe a little bit higher as well. How big is the potential that the Fed might actually have to change course here and think about raising rates?
Yeah, I mean, we think raising rates at this point is still pretty low probability. I think it would take, inflation around 3% probably gets the Fed to hold on their policy rate. Absent a more dramatic increase in the unemployment rate, I think you need inflation that really reaccelerates up to 4 to really get them to start thinking about hikes again. And historically, the way that we've gotten that type of reacceleration in that small a time frame has been about supply side shocks. So you need a global energy supply side shock. I think tariffs. If there were the kind of more aggressive or most aggressive scenarios that the Trump administration has talked about, I think tariffs could possibly do it. But you have to keep in mind with tariffs is that, yes, they are inflationary, but they are also bad for growth, at least in the near term. The United States just does not manufacture the stuff that it consumes, and we just don't have the capacity now. So if you put up walls, so products can't come in, then that just means lower activity and higher prices in the near term until you can create that capacity. So, I guess all of this is to say is that it's a tricky environment. We think that the probability of rate hikes at this point is still pretty low, and we're discussing just how quick, will the Fed get to neutral and how quickly will they get there?
Tiffany, we thank you so much for joining us today. Of course, busy morning on Wall Street and, of course, also at Pimco, Tiffany Wilding of Pimco. Now, coming up next, we're going to talk about positioning for the year ahead. We're going to speak with Marissa Ansell, ETF strategist at Goldman Sachs Asset Management. Also, Dibadj, the CEO of Janus Henderson. All that up next. You're not going to miss those conversations. We're also off to the races. Man, Matt has really brought in
look at that. Jorge
the guest
Martin,
this week.
World champion MotoGP on a Ducati.
The CEO of Ducati joining us for an exclusive interview. The motorcycle maker leads the pack with its third MotoGP World Championship in a row. Man, we're going to be talking a lot about motorcycles this hour. I feel like. So. Stick with us. This is Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. At least 79 people, mostly women and children, have been killed in the Democratic Republic of Congo by a mysterious infection. The outbreak is called Disease X. and health officials expect to know within days the cause of the outbreak, which has sickened hundreds of people. Symptoms include fever, cough, and difficulty breathing. Wall Street bankers that help companies sell debt will get bigger bonuses this year, according to a new forecast by the Options Group. Bond sellers in the U.S. are set to receive a 23% increase compared with last year. Another compensation consultant forecasts the rise in bonuses could be more like 25 to 35%. And a new fund that aims to punish woke companies is getting ready to debut. Azoria Partners expects to launch an ETF early next year that will exclude the S&P 500 companies that incorporate DEI considerations into its hiring processes. The fund will reportedly announce that Starbucks is one of 36 companies that will be excluded from the fund. Katie, I don't know if punish is the right term, but they want to keep them out of their
exclusionary. We'll see how that goes. Of course, we've seen other anti-woke ETFs launch in the past. I'm excited to see this one. But in any case, it's been a record-breaking year for ETFs. Investors plowing $1 trillion into the industry. We have never seen that before, and we've seen it across the board. Equity, crypto, fixed income ETFs had a big month in November after Donald Trump's election win. Let's talk about it now with Marissa Ansell. She is head of ETF investment strategy over at Goldman Sachs Asset Management. Great to have you with us on this ETF Friday.
Great to be here. Thanks for having me.
So let's talk about the flows. We just hit that $1 trillion inflow number for the year. And I have to wonder, are we at peak flows? Does it get better than $1 trillion?
I think it's going to, yeah, for sure. I think, ETFs remain the investment vehicle of choice for our clients. I think it's because of the tax efficiency, the ease of trading, the transparency, oftentimes the lower fees that ETFs offer investors versus other pooled vehicles. And I think, we've seen that in the record flows. We've had just over $1 trillion of net flows into the ETF industry this year. The industry as a whole recently surpassed $10 trillion in assets for the first time. And I think that's set to continue. I think actually one thing that's really interesting is if you look under the hood, active ETFs have really been the biggest growth driver here of assets and flows. And I think that is very much the way that the industry is heading. It's very much what we're hearing from our clients. And I think that's our focus too.
It's interesting. If you didn't know a lot about ETFs, Katie does this explainer constantly for our entire team, which is, you're not just buying the index anymore. You can be buying into active management now. You can buying into bond markets. What kinds of products, what kinds of areas are clients getting excited about now?
Yeah, so I think, again, active ETFs are very much in focus. I think that's very much our focus. At Goldman Sachs Asset Management, we're a top 5 active investment manager. We're very fortunate to have great active investment capabilities across all different asset classes. And so we're really focused on bringing those investment capabilities, that active management, putting it in the ETF wrapper to make it accessible to all of our clients.
So what, within active, you can try and reduce the concentration risk that we see. You can try and place a bet on what you think the Fed's going to do, the economy, and the next administration. What do you think is the most exciting area within active right now?
Yeah, so we have a really constructive view on markets for 2025. But as we speak with our clients, I think there are a few key themes that are really front of mind for them right now. I think on the equity side, to your point, market concentration is very in focus for our investors. I think on the fixed income side, of course, we have rates that are falling for the first time in a couple of years. And I think overall, investors are really keen to try and position their portfolios for ongoing market volatility. So our advice to our clients, in that context, is really one, broaden equity horizons. And what I mean by that is I think next year is going to be the beginning of the broadening. So we're going to start to see more equity market participation. And we are actually very bullish on small caps, in particular here in the US.
We'd like to hear about that on this.
Yeah.
I look at, for example, the Russell 2000. We always hear that like 40% of those companies lose money. So maybe you could have an active ETF focusing on small and mid-cap stocks that actually earn money.
That's exactly right. And so actually, it's a great point in our small cap core ETF, GSC. We do exactly that. It is actively managed for good reason because there are, as you said, a lot of small cap companies that are still loss-making. And so we think you really need to be selective in the asset class. I think for small caps overall, it's a great setup going into next next year. We've got a supportive macroeconomic backdrop. We've got interest rates falling, which is a great tailwind for the asset class. Valuations look very attractive in our view, particularly on a relative basis relative to large caps, where they're trading at a 20 to 25% discount. And I think you could also have some positive catalysts in the form of a pickup in M&A activity, a pickup in IPO activity. So I think all of that comes together to be a pretty positive backdrop for small caps. But to your point, it's really, really important to go active here because every company is very different.
Right.
And I think you need to be very selective and focus on quality.
Yeah, and when it comes to GST, we had Greg Torto on the program just a couple of weeks ago, a great conversation about that active small cap fund. What's interesting to me, the demand that you're seeing in the ETF universe for active is that it's not necessarily for traditional stock picking. You have these systematic strategies that are in focus, derivatives based, this sort of rules based active versus the traditional stock picking of maybe active markets past. Do you see that changing? Do you think that old school style of investing will come back in vogue?
So I think you mentioned derivative income strategies, and actually that's an area that we've seen a huge rise in popularity and interest from our clients. We launched our derivative income strategies, GPIX and GPIQ, just over a year ago. They have been hugely popular with our investors, and I think they are really enabling our clients to do a couple of things. One, to stay invested in the market, so they combine an equity portfolio that gives exposure to either the S&P 500 or the NASDAQ 100, and we have a call writing overlay on top, which allows investors to achieve stable and pretty attractive monthly distributions.
You know, we only have a minute left here, but I do want to pull up GSST. This is your ultra short bond ETF. You made the point to us that those trillions of dollars in money market funds, maybe they don't go right into equities. Maybe they go into different parts of the bond market first. What's the case for that? Are you seeing it actually happening?
Yes, we are. So very much our investors, I think, are starting to leg out of money market funds. We've got $6.5 trillion almost sitting in money market funds here in the US. And, over the last couple of years when rates were high, that worked well. But now, there's a growing opportunity cost of keeping cash in money market funds. And so we're seeing investors start to leg out. The first stop is ultra short duration. So GSST, which is our ultra short duration bond ETF, is really finding great opportunities across spread sectors, in corporate, securitized credit. But again, I think it's really important to be active and really be able to capitalize on individual opportunities there.
Well, Marissa, it's great to get some time with you. Really appreciate you stopping by on this Friday morning. That is Marissa Ansell of Goldman Sachs Asset Management. Thank you. And be sure to tune into ETF IQ every Monday at 12 p.m. Eastern. But we do want to bring you some breaking news right now. This in the social media landscape. This headline coming that TikTok faces a U.S. ban after an appeals court refuses to block law. We're just getting some headlines now. Apparently, Trump's opposition to the ban likely to complicate its enforcement. Not a lot of details here right now, but again, to reiterate, TikTok faces a U.S. ban after an appeals court refuses to block law. You can see social media shares reacting strongly right now.
Right, you have Snap shares rising as much as 7%, Meta extending its gain to about 2.4%. We'll keep a look at those live. But, this also revisits that idea of what happens to TikTok in the United States. Do we have M&A? Do we have the separation from ByteDance? The moves around this are pretty enormous when you think about the investor base that can get involved.
There's only a couple months left until it doesn't really matter, right? I mean, Donald Trump comes into office, and how do you enforce this kind of law? If the president is behind TikTok, enforcement seems pretty difficult. We can pretty much access anything on the World Wide Web, right?
Yeah,
Try and
that's
stop
true.
me. It's not going to happen.
Yeah, we'll see. It is interesting. I mean, Snap shares were up as much as 7%, now coming back a little bit. So it's clear investors are trying to make sense, of course, of this breaking news that we do have. Let's try to make sense of it now with Caroline Hyde joining us back again at the desk.
My favorite TikToker, actually.
Really? No
yes.
kidding.
I don't know if he
Very
still
good
does
at
it,
it.
but she...
Daily friend.
Do you still do it?
You might have to
Not dancing
diversify.
so much anymore. It's just straight up.
I like the burrito
Well,
thing.
let's get to this breaking news. What do we know so far?
What we know is that they still face a ticking time bomb for their own, whether or not they will indeed be banned come January the 19th. And then, of course, what happens for the extension. This is important because half of all Americans use TikTok. And even the president-to-be in 2025 uses TikTok. So the view is that probably nothing gets held up. we do hit, but they appeal, and basically that's going to push it into the long grass. We'll probably get like a 90-day extension come January the 19th, so that it then is dealt with by the next administration. And then you have to read the tea leaves of Mark Zuckerberg apparently reportedly having lunch in Mar-a-Lago with Donald Trump, whether or not we can see some conviction there that TikTok does still need to be banned from a social media competitor's perspective. Because remember, everyone was upended by Trump's perspective that initially it was Trump who wanted to ban TikTok, wanted to push against China. And then he did a complete 180 by saying he didn't want to see ultimately the competitive landscape change.
Well, it's not just pushing against China, right? It's the fact that the Chinese can listen to you and watch you. They get your data, right? They can use this to spy on you. That's the problem. It's not.
That's the logic.
I want to go back to the point that you were making. In a couple of weeks from now, how much does this matter? At the end of the day, where is the power? This was a court decision, right? What happens next in terms of what the president-elect could say about this and how much that could change the course of this decision?
I mean, I don't want to preempt trying to decide exactly what comes out of President-elect Trump's mouth or indeed what executive orders come about. What you do have to know is how many venture capitalists are backing the parent company ByteDance. A lot of them are incredibly powerful people. We also have the likes of Sequoia, General Atlantic, some very heavyweight private equity and VC names who ultimately don't want to see the erosion in the value of ByteDance. We've had a venture capitalist on recently who's been buying up more of ByteDance's shares on the secondary market, saying, look, ultimately, TikTok isn't that important to ByteDance's overall valuation. It's still so healthy in China. But ultimately, we do have some big Republican donors who have backed TikTok as well, so likely to see that.
And Chinese. Don't forget China, right? Because this is their big advantage.
Well, more coverage coming up on Bloomberg Technology, I'm sure. That is Caroline Hyde, the co-host of Bloomberg Technology. Don't go anywhere. We'll speak with the CEO of Janus Henderson up next. This is Bloomberg.
Janus Henderson has been on a growth tear, recently agreeing to acquire an asset manager to focus on private credit, all the while launching a spate of new ETFs. They are finding clients shifting their investments in a meaningful way. And to talk more about where their clients are going, Janus Henderson CEO Ali Dibadj. And, you know, it was only a few months ago that we reported on this deal to buy Victory Park Capital. Fast forward to December, you have BlackRock buying HPS. This has been a hot space. And in your view, what's the future of it? Why are so many big traditional asset managers saying we need to be over there too?
Well, thanks for having me again. Good to see you, Sonali. Look, I think the opportunity set continues to broaden in all opportunities for investment management, and of course on the private credit side as well. Now, Victory Park Capital, we're very proud of that acquisition. We think it's the best in the business. They focus very much on the asset-backed side of things. We see a lot of capital shifting away from just the pure direct lending side all the way to the asset-backed side. It's safer, it gives you a better return, and there's still a lot of opportunity there. We see that also, you mentioned the ETFs, flowing through very much in parallel to what we're seeing on the public area. So JAAA, for example, is a perfect example of that. You know, JBBB, these are ETFs that are more on the securitized side, that are on the public side of things, which parallel what's happening on the private side in our Victory Park acquisition.
You know, it's interesting when you think about this convergence or divergence. I think there's a big debate out there. You have Apollo sitting on one hand saying that the two can come together. It's all in one the same. We're going to make a private credit ETF alongside State Street.
Put your 401ks in it.
Yeah, absolutely. But then you have others in the private capital space saying, and it's not going to happen. You have Blue Owl saying that private is private for a reason. And yes, it's hard to access, but you're paying for that. Where do you stand on that spectrum of that debate?
Well, I think when you see things fall apart, it's often when the time frame, the liquidity needs of the person investing in it is different than the time frame and liquidity needs of the asset. So privates, by definition, are privates. What you're getting the benefit from is something being a little bit more illiquid, and so you get a little bit more returns. If you can handle that illiquidity, then that's okay. You can benefit from that. But oftentimes when people think about ETFs, it has to be liquid. So I think the marrying of the two is actually quite challenging. You have to make sure that there's enough liquidity to benefit from people who actually need that liquidity. So look, time will tell. I think it all will depend on the mix between privates and publics within ETF form. Certainly we are interested in doing that. Others are interested in doing that. But that mix has to be right, and the asset base underlyingly has to match what the investors' needs are.
We're going to get to ETFs. I have about 7 questions to ask you there, but I do want to meditate on privates and the alternatives business for a little bit longer. You mentioned Victory Park, a little bit more asset-backed focus there. We're talking about anything from consumer debt to music royalties, but when it comes to your ambitions in the alternative space, where do you want to compete? What areas are you specifically looking at there?
Well, I think it's a great question, Katie. One of the areas for us that we're decided to do is not to compete in some areas that are becoming basically commoditized. So I talked a little bit about the traditional direct lending area. Most of what's happening in the direct lending space right now is sponsor-based. In other words, you're just lending money to a company that also is a private equity company. So by the way, that creates correlations within your portfolio. If you have private equity exposure, you're also then lending to the companies. Not always the best. It's not uncorrelated from that perspective. The other element is these direct lenders, many of them, not all, to be fair, but a lot of the more later entrants have come in, and they just lend on the basis of who that sponsor is. They don't actually do diligence on the underlying company. That's not fundamental to what Janus Henderson does and is, right? We are underlying fundamental analysts. We have 340 people around the firm. That's what they do. They look at what companies, what securities to invest in or not. A lot of what's happening in direct lending is it's effectively becoming a broadly syndicated loan market.
Right.
Less beneficial to the end investor, much more commoditized. So we're not really looking there as much. Where we are looking, very much as you described it, is these differentiated areas, asset-backed, royalties, litigation finance, other areas that are really orthogonal, provide clients with a different correlation, great returns. Those are really the areas we're going to be continuing to look at.
Hang on, what are those areas? Orthogonal?
So uncorrelated returns, right?
Okay.
So think about lending to a music royalty. So that's completely not related to what's happening in the markets. That's completely not related to anything else that's going on. That's really based on that asset. And that's the type of stuff that we're looking at. And Victory Park Capital is a great example of that. That's an acquisition that we just made that we were talking about. And that's more of a developed market aspect to it. But we've also made an acquisition in the emerging markets as well. So NBK Capital, it was a captive private investment arm of the National Bank of Kuwait. We brought that in-house, and that has enormous amount of opportunity to invest in the private markets, in the emerging markets, where there's still not as robust a banking system, but extraordinarily interesting entrepreneurialism that needs this private capital.
I need to ask about ETFs, but you talk about these acquisitions. I have to ask, do you have any more planned? Is that your strategy from here, basically this inorganic growth?
It's certainly part of the growth trajectory. And when we do something, you'll be the first to know. We'll be happy to be back here and chat about it. But yes, look, I think there's enormous opportunity across the board for us to deliver better for clients.
You know, I do want to move to ETFs
let's
because it's
do it.
interesting. You know, you were talking about that $1 trillion mark that we surpassed here. It's a big moment, right? And if you think about the growth moving forward, where is it most going to come from? Because it's no longer the days of just buy the index and walk away. People are really worried about concentration risk. So what would you dive into? What are your clients diving into right now?
I think your first point there is extraordinarily important. This is no longer an age of set the dial and walk away. The tide will not lift all boats. The world is so complex right now. There are geopolitical changes that are going on, obviously. Demographics and population has effectively peaked, and this kind of big driver of consumption is pulling back. We have to think about that. Clearly, the cost of capital is much higher as well. So it's a much more complex world. I think you're exactly right. One has to be much more active in the marketplace and pick and choose. So broadly, from an investment perspective, we actually see that the opportunity set continues to broaden in terms of where to go. But take the ETF world, as we talked about, and take fixed income even more so. So there should be a big move from going from cash to investing in the fixed income landscape right now. But not all fixed income is created equally either. So for instance, if you're going to go into corporate credit right now, corporate credit spreads are the tightest they've been in a very, very long time. On the flip side, on the securitized side, there's significant opportunity. Things are cheaper than they've been over the past decade on average. So we believe that's a securitized area, whether it be JAAA, JBBB, the JMBS, the mortgage-backed securities that we have, some of the short-term areas that we have like vanilla, JSI, which is securitized. We see enormous opportunity to continue to be there. But to zoom out a little bit, again, given this world of have and have-nots, think about our equities portfolios. We see enormous opportunity on our equities portfolios. We think global small cap and small cap in the U.S. and around the world will be huge opportunity for folks to invest in. Again, not because the tide will lift all boats, but because there'll be alpha creation between the haves and the have-nots.
Right.
And that's what we do for a living at Janus Henderson.
So you bring up JAAA. That, of course, is your AAA-rated CLO ETF. It is absolutely dominant in the space, by and far the biggest there with almost $16 billion. There was an interesting innovation this week in the CLO ETF landscape. We had two private credit CLO ETFs launch. And we're not talking about true private credit, you could say. Of course, we're talking about a pool of loans rather than one borrower working with one lender here. But what do you make of those funds? And given how dominant you are in the space, is that something that we could see from you?
So I think it depends on the liquidity of the underlying asset base. In an ETF, the expectations are that an investor can come in and redeem and it's liquid. If by definition it's private, typically that's much more difficult to then get that liquidity out of it. In particular, so if you're not negotiating with one person, we actually have a pool, exactly as you described it, of loans. It's really hard to get that liquidity in some of those instances. If it's a pure private credit, I think that's a little bit of a leap right now. If you can imagine a public-private combination, we have the securitized private side with Victory Park Capital, and then we have a securitized public side with the team that we have in the US and also globally. That mix could be something quite interesting because you could apply the liquidity from the public side and then have the better returns on the private side. But pure private to me right now, I think we'll have to see what happens in downturns. I'm not super excited about those.
Ali, great having you in. Really fascinating stuff. Ali Dibadj there of Janus Henderson. And you have a newsletter?
Yes.
What is it? An ETF
IQ.
I know you have a show.
No. I have a newsletter, too. We have ETF IQ, the television show. We have ETF IQ, the newsletter. That comes out Fridays at 2 p.m. You can subscribe at Bloomberg.com/newsletters.
That's exactly what we should promo.
That's a good
because you'll
idea.
probably use some of this.
Yeah.
You could use some of this interview.
I definitely will.
Matt clearly likes to talk more than he likes to read. But
Oh, that was a deep burn.
But you're great at it.
You know what
so.
I like to do? I like to ride. And it's been quite a ride for Ducati as it rounds out another record-breaking year. We're going to talk to the company's CEO, Claudio Domenicali, after winning his third world championship in a row at the top of motorcycle racing in MotoGP. This is Bloomberg.
All right, it's time for our daily Wall Street Week conversation, and only 2 U.S. seaports made it into the top 100 of the World Bank's annual Container Port Performance Index. David Weston spoke with S&P Global's head of port intelligence and analytics about why U.S. ports are inefficient and how they could be improved.
You have ports with different characteristics and different profile of calls. You have some ports that are strongly focused on imports, some ports that are strongly focused on exports, or as you say, others strongly focused on transshipment. But all ports should have the capability to do what they do very well and to work vessels as efficiently as possible. The data shows the amount of time it takes to turn around vessels, cross-referenced with the workload achieved in that time. The methodology is standardized across all ports. It's not perfect, but it has a very important function to enable a focus on identifying the opportunities for improvement and helping to de-risk this critical sector.
Tell us about those opportunities to improve efficiency. What are the basic steps at a port, and where are the ones where you can find the most efficiencies and make the most improvements?
Yeah, so in order to improve efficiency, the port has things that it can control quite effectively, but there are other things that are more difficult to control and in some cases perhaps even impossible to control. Things you can control are clearly good processes and planning around things like gate planning and execution, vessel and yard planning, scheduling equipment maintenance, and that sort of thing. Certain ports have organizational limitations that impact efficiency. You have ports that can operate 24/7. You have others that are limited in doing so because of maybe labor framework agreements, certain bylaws or customary practices. So clearly, if you're able to operate 24/7, you can turn vessels around faster and you can drive a lot of additional efficiency into your operations. Some ports have physical limitations, perhaps navigation issues or tidal issues that they have to contend with that will also impact efficiency. You may have infrastructure challenges, either planned or unplanned. Natural disasters can take heavy port infrastructure offline, or civil works and maintenance can also impact the usage of infrastructure.
And that was S&P Global's head of port intelligence and analytics, speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. Coming up, we'll speak with the CEO of Ducati Motors, all about motorcycles. This is Bloomberg.
I think we are very well positioned with the plug-in hybrids. The important thing is that you have to keep the promise, being us a car manufacturer which is not selling mobility but dreams. On one hand side, the design has always to be new. We have cutting-edge technology, and we have to keep the promise that this generation is more performing than the generation before.
They are selling dreams. They're selling passion. It's luxury. It's not industrials. That was Lamborghini CEO Stefan Winkelmann speaking earlier this week on Open Interest. Lamborghini is part of VW's Audi Group, which also includes luxury brands Bentley and Ducati. The Bologna-based motorcycle maker is at a high point right now, and it's almost 100-year history, earning back-to-back-to-back MotoGP World Championship titles, 2022, 2023, 2024. Now joining us from Borgo Panigale is the CEO, Claudio Domenicali. Claudio, thanks so much for joining us. It's fantastic to have you on. I probably should disclose, if people don't already know, I'm a massive Ducati fan. I'm a collector, a rider, and so I'm to some extent biased, but I wonder how your sales numbers are affected by these wins. Is it still win on Sunday, sell on Monday? Is that how it looks for you?
Yeah, pretty much. Actually, I think that we are receiving a fantastic boost from the result that we are having in racing. This year has been the most successful year in our history ever in MotoGP. You know, we won 19 races over 20, and it's the fifth manufacturer championship in a row, the third rider championship in a row. So it's fantastic. The global market, it's under pressure. It's a bit under pressure, so many manufacturers struggle. But here in this contest, the support of racing is helping us a lot. If we will see the final number at the end of the year, when we count volume, it will not be our best year ever, but will be a very good year anyhow. And also the financial will be okay without releasing any number, because we have not yet finished. So I would say that in this contest, with some headwind that there is generally in the market, racing is helping a lot.
What are the biggest headwinds here? I mean, the economy, certainly in the U.S., looks pretty strong. It's your biggest market. Rates are coming back down. We've got a little fire alarm going off here. I hope it's just a drill. Rates are coming back down. Are people in the U.S. going to buy more and more motorcycles? Are we going to get back to the million plus motorcycles that we were selling at the peak this century in 2007?
I don't think so. I think that part, the million plus, was a bit inflated by an extraordinary low cost of financing, and so was kind of not normal. But still, the market is going back, and it will not get to this high, but still will be quite interesting, especially if there is a possibility to propose models that are innovative, which what we feel we will be doing, or we are doing, with this, we call it the magic combination of technology and design. And so technology will play a major part there. So having product that actually can be exciting and interesting even for young people and young generation that have been growing with the smartphone in hand, and so they are very much attracted by technology in general.
We see more and more special motorcycles, unique liveries, special editions coming out from Ducati, the Speciali projects and Unica, where you allow people to customize products to their own liking. Is that boosting margins significantly?
Oh, yes, very much. And it is very positive on that side, of course. But also it's very positive in shaping the brand, most probably one of the best, if not the best, in the sports bike arena, in offering a one-to-one relationship with the client and customization. And so it's on the Unica project that it's a kind of thing in which you come here in Borgo Panigale, and together with the designer, you can, if you are one of our top client, design a special bike only for you with special material, special treatment, and actually we will ride on the bike one-on-one, and we give all the material together with the bike and the warranty that Ducati will never do another bike the same. And on this project, we can do something like very few, like 30 a year, but actually we have a 3-year waiting list. So it's very successful, and it's more than the margin, which of course are very interesting. It's much more brand shaping.
I guess I'll see you there then in 2028. Claudio, I want to finally ask about dirt bikes, because you're winning so much on the track, and you're famous as a street bike, a super bike maker. But we saw Paolo Ciabatti leave MotoGP for off-road racing, and I think you won your first Italian championship in the dirt. When are we going to be able to buy Ducati dirt bikes for ourselves? When is the retail crowd going to be able to get a hold of these products?
A time is coming. Next year, mid of next year, the bike will be on sale. The MX-1 bike, so the Desmo 450 MX, will be on sale worldwide. So, of course, even in the US. And we had, it's a long project, so it's more than 3 years. We're working on that. And this year, we raced in the Italian Championship. That actually, we take the title in that in order to make sure that once we sell the bike, it's exactly the level every Ducatista is expecting, and every passionate off-road racer is expecting if a brand like Ducati decide to come and race off-road. So we are feeling ready to come, and we'll also race MX in the World Championship next year, and we will start also making experience for Supercross, in which we have programmed for 2026.
I love it. Racing off-road with desmodromic valves. Claudio, thanks so much for joining us. Ducati CEO Claudio Domenicali coming to us from Bologna.
All right.
That's, for me, that's pretty great.
I'm happy that you had that.
Thank you. Thanks for giving that to me. Thank you.
While that was going on, of course, the market has continued to rally. Green on the screen for the S&P 500. We're looking at a third straight week of gains. The S&P 500 up 1% to end the week.
Not hurt by the fire drill.
No.
Right? Do we have to leave? Should we evacuate?
I think we should. I think it's about time to get out of here.
It's time to end the show, but a lot coming up on Monday.
Yeah, on Monday, DHL Express U.S. CEO Greg Hewitt joins us in the C-suite. Have a fantastic weekend. Don't burn down. This is Bloomberg.